Hello and welcome back to my channel. My name is David, and I have been a financial analyst for over 29 years. Today, I would like to share with you the first part of my mini-course on how to analyze a spread in a complete and clear manner. First of all, I want to make an important point. You have probably come across online ads claiming that following seasonality alone is enough to make profits, suggesting that spread trading is an easy path to success. However, the reality is quite different. Spread trading is simply another form of trading, and it's no easier than any other. It always requires knowledge, experience, discipline, and, of course, a solid analysis plan that provides you with all the necessary information to trade with the odds on your side. Now, let's get to the heart of the matter. What is spread trading? Spread trading in commodities is an investment strategy that involves buying one futures contract on a commodity and simultaneously selling another futures contract on the same commodity with a different expiry, or on a correlated commodity. The goal, therefore, is to profit from the relative movements between the two instruments, rather than from the absolute price changes of individual contracts. With spread trading, you are no longer focused on a single price, but on the difference between two prices. One of the advantages is that you can profit whether prices rise if the futures contract you bought increases more than the one you sold, or fall if the futures contract you bought decreases less than the one you sold. Here are the three types of spreads, depending on how they are structured. Intra-market. This involves buying and selling futures on the same commodity but with different expiry dates. This type of spread is also known as a calendar spread. For example, here is the chart of the ZCZ24, the ZCH25 spread, created by buying the December 2024 corn futures contract and selling the March 2025 corn futures contract. Intermarket. This involves buying a futures contract on one commodity and selling a futures contract on another commodity with the same delivery month. Intermarket spreads can also become calendar spreads by using futures with different delivery months. For instance, here is the chart of the LEZ24-HEZ24 spread, constructed by buying the December 2024 live cattle futures contract and selling the December 2024 lean hogs futures contract. Inter-exchange. A less common method for creating spreads. This involves using futures contracts on the same commodity but from different exchanges. For example, here is the chart of the ZWZ24-KEZ24 spread, created by buying the December 2024 wheat futures contract from the Chicago Exchange and selling the December 2024 wheat futures contract from the Kansas City Exchange. Typically, a spread is constructed by subtracting the more distant futures contract from the nearer one. However, nothing stops you from doing it differently, though this might cause some confusion in the analysis. A key concept in spread trading is contango and backwardation. Contango occurs when supply and demand are in balance, which is the typical market condition where the price of a commodity futures contract is higher than the spot price, and contracts with more distant delivery dates are priced higher than nearer ones, as shown in the chart. If demand is weak and supply is excessive, the market tends to amplify the contango, which is considered an anomaly. Backwardation happens when demand exceeds supply. In this scenario, the market tends to reduce the contango and even invert the curve, as shown in the chart. Backwardation, too, is generally considered an anomaly. When analyzing a spread, unlike what is often taught in courses, seasonality is just one part of the analysis process, and not the main element. Courses tend to focus on the same few concepts. Selecting a seasonal spread, checking past trends, examining the current price level, and looking for correlations with previous years. Some, who really should be called out, even suggest comparing the current spread level with seasonal patterns levels, which is completely incorrect. To understand seasonal patterns correctly, I recommend watching the video I created, which you can access by clicking here on the top right. Relying solely on seasonality is like driving at night with your headlights off. If there are no obstacles, you might make it home, but at the first hurdle, you will crash and get hurt. I have been a commodity spread trader for over 15 years, and during this time, I have developed an analysis method that allows me to understand the exact situation of a commodity and, consequently, the spread. This approach gives me an advantage, putting the odds of success on my side. The method I have refined consists of 5 parts, of which seasonality is just one. It's important, yes, but no more so than the other 4. Analyzing the historical performance of a spread can be useful, but if you don't know the current situation of a commodity, how can you know if the seasonality will be followed? If there are no disruptions, then seasonality will follow its course. But if an unexpected event occurs, like a drought that threatens the harvest or an outbreak of disease affecting livestock, and you are unaware of it, you will end up getting hurt. If you don't recognize an anomaly in that commodity, or if you are unaware of the sentiment among major investors, you are essentially driving blind. With climate change and ongoing conflicts, anomalies in commodity markets are on the rise. Times are changing, and so are the markets. While the type of analysis taught in courses, though simplistic, may have worked 15 years ago, it's no longer sufficient today. If you are truly interested in becoming profitable in spread trading, I encourage you to follow this mini-course closely. What I will be explaining to you here, for free, is not taught in any paid course. As you will see, conducting a thorough analysis requires time, effort, and discipline. Spread trading is no different from Forex or the stock market, even though some would have you believe otherwise. Thank you for watching this video. Continue following this mini-course, as I will explain the 5 steps to achieving a complete and clear analysis of a spread, giving you all the information you need to put the odds of success on your side. If you would like to delve deeper into the topic, I have written 2 books where I thoroughly explain these concepts and many other aspects of spread trading. You can find the links to purchase them in the description below. If you enjoyed this video, please let me know by giving it a like, and if you don't want to miss any of my future videos, I invite you to subscribe to the channel and click the notification bell.